Welcome to this week's video where I discuss what I believe is important for individual investors to consider over the next 5 to 10 business days before they make their investment decisions. I think you have to take a look at the Federal Reserve first and foremost. How quickly will they raise interest rates in the coming months? There's talk that they could raise 1 full percentage point at the next meeting. We'll have to see. Is the economy still holding up? How well is the economy still doing in the face of these high interest rates? And lastly, corporate earnings season is now upon us. We're about to hear from some of the largest companies in the world. How are they faring? How was their first quarter? And what are they saying going forward? Will the second quarter be as good? Stay tuned. Recently, there's been a lot of talk from the Federal Reserve themselves talking about how quickly they believe they need to raise interest rates in the coming months. We're about to get at least a 50 basis point hike out of the Federal Reserve in May, but many are now starting to talk about how a 50 basis point could turn into perhaps a 75 basis point increase, or maybe even a full percentage point. If the Federal Reserve decides to stick with 50 basis point increase, perhaps at the next meeting they may do another 50 or maybe 75 points. Overall, I think the market is very fearful of this. It's come to grips with this idea of rising interest rates this year, but what the market seems to struggle with is the speed of this increase. How quickly will the Federal Reserve raise rates? I know there's been a lot of talk again recently about front-loading the rate increases, perhaps get them out of the way the first part of the year, and in the second part of the year, let the economy and the markets digest the increase. We'll have to see. Overall, I would say investors should be prepared for a continuous bumpy ride in the markets as the Federal Reserve grapples with this rise in interest rates and how quickly they need to do this over the coming months. Over the last 6 to 12 months, we've seen a very resilient economy. The economy continues to hum along. We see strong retail sales. We see strong housing data. We're seeing overall economy do extremely well in the face of rising interest rates. I think individual investors need to continue to look at this data. They need to understand that even though interest rates may be rising quicker than anticipated, that the economy can withstand this rise in interest rates. If we do start to see things slow down, will that mean the Federal Reserve will slow down? I don't think they will. I think the Federal Reserve is willing to take that chance to raise rates quickly to slow down a hot inflation rate and a hot economy and perhaps go a little bit overboard. They've said that already on a few occasions. So I think it's very important for us as individual investors to keep an eye on how things are going. How are retail sales faring? What is the average individual investor saying? Are they still willing to invest money out there in today's market? Are they still looking for a job, or do they have a job? How is the labor market performing? These are all indications of how the economy is doing and how it is handling the most recent increase in interest rates by the Federal Reserve. So keep one eye on interest rate increases and the other eye on the economy and how it's coping with these increases. In my opinion, corporate earnings is off to a great start out of the US. Canadian corporate earnings are just starting currently, and we've seen already Rogers Communication report a good number. Overall, I think US banks, some of the big tech names, some of the airlines have shown us fantastic earnings. Not only have they shown us great earnings, but their outlook going forward is very strong. So as an individual investor right now, I think what you're seeing is, on one hand, good corporate earnings, and on the other hand, an aggressive Federal Reserve. Which one is going to win out is the question I think we all need to ask ourselves. But in the long run, if corporate earnings can remain strong, and we're about to hear from some of the largest corporations in the world, the Microsofts, the Apples, the Amazons, Facebooks, the Googles, or Alphabet, if they can maintain good quality earnings and maintain a very good growth rate, once again in the face of higher interest rates, this should encourage more investment. This should spur on more investment in the markets, especially in the technology space, which has taken on the chin quite significantly over the past 3 to 6 months.